Hey, what is up? Today I am going to show you how you can retire with just $20,000. Now I don't mean that when you retire you're only gonna have $20,000. I mean starting today with $20,000, how you can retire through real estate. It's very simple and it's very powerful. So let's take a look at how we can do this. All right, let's say that you do have $20,000. You can buy a $100,000 property, put 20% down, and have an $80,000 mortgage. Now, some of you might be looking at this and be like, no way can I buy a $100,000 property in my area. Well, that might not be true, but probably within a couple hours of you, there's probably a spot where you can pick up some properties for a decent price. If that's still not the case, you can always invest farther away from home. So 100K, we're gonna have an 80K mortgage. That's going to run us about $500 a month, plus we will have taxes, insurance, maintenance, repairs, those kind of things. Now, for the purpose of the example, we're going to use the 1% rule. The 1% rule says for your purchase price or the value of the property, 1% should equal the rent. It's a pretty good rule of thumb and it works in a lot of different markets a lot of the time. So let's just use that. It's worth $100,000, so we can get $1,000 a month in rent. So this is our first property. We've already spent all of our $20,000. Now what? I can't retire on one property. So we're gonna have to buy a second property. How are we gonna do that? Well, let's just say that we have positive cash flow of $200 a month. So that allows for taxes, insurance, maintenance, repairs, things like that. We'll have $200 a month. So that's gonna take us quite a while to save up $20,000, but let's see what happens. It's going to take us 8.5 years to save up $20,000 for our next down payment, and we can buy property number 2. At this point, then we will have $400 a month in passive cash flow, positive cash flow. Then we can buy property number 3. This is just going to take a little over 4 years, and now we'll have $600 in positive cash flow. So to buy our 4th property, it will take us a little less than 3 years to save up those funds, and will be positive cash flow $800 a month. Then property number 5, it's going to take us 2 years, and we'll have $1,000 a month. And number 6, it will take us less than 2 years, and we'll have $1,200 a month in positive cash flow. Okay, so now we've got our 6 properties. This took us just under 20 years. We'll round it up to 20. All right, so 20 years, 6 properties. We've got $1,200 a month in positive cash flow. So on our first property, at this point, we'll owe $39,000 on it. And we can actually pay that off in just 2 years if we apply this number to the principal. So in 2 years, we can own that property free and clear. Then we will have, for property 2, we'll actually have another $500 in cash flow from this property because we don't have that mortgage anymore. So we'll have $1,700 a month to throw at the debt on the second property that we bought. That one we owe $62,000, and that one, applying the $1,700 a month to the principal, we can have that one paid off in just 3 years. Now, at this point, we're at 25 years if this is the road we take. In 25 years, you could have 2 properties owned free and clear. You could have positive cash flow, which would be $2,200 a month because that mortgage is gone. At this point, you could stop or you could continue. It's totally up to you and what your goals are. You could continue to pay down the debt, which is probably what I would do at this point because you're later in the game. That would probably only take a few more years to continue this debt snowball pattern. At that point, you would have, once you clear all the debts, you would have $4,200 a month in passive income. Your equity in the properties at that point, once they're all paid off, would be $600,000, although they'd probably be more because we're not including appreciation in this example. Typically, property values go up, so it could potentially be more. This number would also, I would assume, be more because rents also go up. So these numbers could look a lot better. This is a very conservative example, but it just shows you the power of just buying a property every once in a while. Using this method, you can use your same $20,000. That was just your initial investment. So this just shows you the power of real estate and that you really don't need to start with much to get to a big place later on. And this is not a lot of work, guys. 6 properties is hardly anything. Hey, if you are an aspiring or new investor, I'm here to help you level up your investing game. So consider subscribing if you haven't already. Drop a comment below, like this video, and we will see you in the next one. Later.